There are a couple differences between a restricted stock unit and a restricted stock award. With a restricted stock unit, you actually have to earn the right to receive the stock by working a certain number of years during the vesting periods. With a restricted stock award, you actually get the stock up front. You have to earn the right to keep it through the vesting periods. So you might be granted originally on day one $100,000 worth of stock. There's a 5-year vesting period. If the market value of the overarching stock grant is $100,000, the portion of that will vest in years 2 through 5 will be $25,000. Again, that's the current market value in each one of those years. Let's forward to year 2. You have the first portion of that grant that's vested. Originally, the market value was $25,000. During that time frame that it was subject to vesting, it has now increased to $35,000. You now take possession of that. The market value is $35,000. So you get that, but your employer has to withhold for taxes. Typically, they will sell $10,000 of the stock. You're left with $25,000, so that tax withholding is accounted for. Now, depending on your tax bracket, you might have to pay more or possibly get a refund depending on how much was withheld, but at least the employer is doing that on the front end. But they're having to liquidate shares in order to do that. Other than that, they are fairly similar. With the restricted stock unit, again, you don't have the stock in your possession, so if the stock for which you are being granted happens to pay dividends, it's of no consequence because you don't have the stock in your possession. With the restricted stock award, if that stock happens to pay dividends, then you receive those dividends, and unlike stock that you might hold for at least 60 days, and if it's qualified, those dividends are taxed at a capital gains rate, which is much lower than ordinary income. However, because it's tied up in this type of compensation program with a restricted stock award, you pay wage income on those dividends. So it might be nice to get those dividends, but you're not giving the advantageous tax rate that you are if you held the stock outright, which will occur once you have fulfilled the vesting requirements. One decision that employees must make is whether to make the 83B election. Let's just take that same example. You have $100,000 worth of stock at the time that you're granted. It's subject to the same 5-year vesting requirement. But you're thinking that, well, I think this stock might take off. Maybe that $100,000 you feel might be worth $1 million in 5 years. And you say, well, I don't want to have to pay tax on $1 million as it vests. I'd rather pay tax now on the $100,000. Well, that's what you can do with the 83B election, is essentially upon the grant of the stock, even though it's subject to vesting requirements and you can't sell it, you can elect to pay tax on it now rather than later. So therefore, in this example, if there's $900,000 of appreciation that ordinarily you'd have to pay wage income on all of it, in this particular case, so long as you've waited a year after you've made the 83B election and when you have sold the stock, which in this example, that 1 year you've satisfied the vesting requirement, you'll pay long-term capital gains on $900,000, which is substantially less than what you'd likely have to pay under your ordinary income rate. Now, there are a lot of risks to doing this. If it's $100,000, you're paying taxes on $100,000. If the stock goes south, it doesn't do well, or perhaps even goes out of business, you're out of luck. You paid tax on a stock that you'll never get. You may also be, well, let's hope you won't be let go, but if you get let go or you leave your employer, you've already paid tax on that stock. So you're out a lot of money on those taxes. That's a huge risk. So for a lot of folks, the best strategy, if you're going to make the 83B election, is if the value of the stock grant is fairly low. So for example, let's say it's $5,000 or $10,000. Well, that's not so much of a tax hit. And if you have a lot of confidence in the success of your company, even if it doesn't work out, you've only paid tax on $5,000 or $10,000. The risk isn't as high. But once you get into six figures or above, of course, paying tax on that amount with a possibility of never even seeing that stock in the end, that's a big risk. So in most cases, it doesn't make sense to do that. You only have 30 days to make the 83B election. So if it's something that you're pondering, you have to get on it almost immediately, because after that 30-day period, you're not allowed to go back and change your mind.